Right, well, we are here at the top of the hour, 10 a.m. Here this morning. On your screen, we have our gold sponsors. We have Hogslat, Christensen Farms, Crystal Springs, and Heartland Builders of Columbus. So thanks to them for being gold sponsors and their contributions to this program here today. We ended that last conversation talking about some cash flow concerns and financing, and I think that's a perfect segue to our next discussion here on the program this morning. We've got four representatives with us here today. We have Chris Ford, who's a swine industry specialist with Farm Credit Services of America up in Omaha. We have Bruce Eberly out in Grand Island. He's with Rabo AgriBank. We have Dave Van Pelt here in Lincoln with Midwest Bank. And then we have Brian Williams, who's an economist with the Nebraska Public Power District. Again, give you guys each a chance to introduce yourselves and your company. Chris, you want to go ahead and lead us off here this morning?
Yeah, thank you, Will. Appreciate the opportunity to be here today. Great segment there with Carl and Rod. I just want to thank AFAN for the opportunity to be here and kind of discuss pork production in Nebraska. As Will mentioned, my name is Chris Ford. I am a retail commercial lender with Farm Credit Services of America out of our headquarters here in Omaha. I've worked for Farm Credit for a little over 12 and a half years. 11 of that I was in credit underwriting in the swine industry. So my entire time I've worked with the pork production. Farm Credit Services of America currently has about $30 billion in loan volume, more than 51,000 customer owners, and about 1,700 teammates. 2019, we paid back to our customer owners about 1% of their average daily balance in cash dividends in the amount of about $265 million. We participate in our swine team on 19 of the 20 largest pork producers across the nation. So our exposure in swine operations is quite extensive, and we get to see a wide variety of pork production across the nation. So I just wanted to kind of introduce myself, and again, thank you for the opportunity to be here today. Appreciate the discussion that we're going to have.
Thanks again, Chris. We'll go over to Bruce.
Good morning, everybody. My name is Bruce Eberly, and I work for Rabo AgriFinance. I'm based out of Grand Island, Nebraska. Many of you probably already know our company, but a bit of the background is Rabo AgriFinance is the U.S. production finance company of Rabobank. Rabobank is the largest ag bank in the world, and we have operations in all the major production regions around the globe. We also station research analysts in each of these areas, and we use that market intelligence to help our producers, our clients, gain an advantage in their operations. We help them to stay ahead of the markets, to find new opportunities, to share knowledge and network with producers that can help them advance their ambitions in agriculture. We do offer a full suite of products from the traditional loans and lines and leases. We also have cash management, treasury management services available. We finance, everything from pork and poultry and beef to tree nuts and beer and all kinds of different things. So if it's production related, we're involved. We have offices across the United States, operating in all 50 states, and we've worked very hard to make sure that our customers have the best resources available and bring in new knowledge to their operation, help them network. We built a platform called globalfarmers.com. It's kind of I describe it as like a Facebook for farmers. It's a proprietary platform to help our clients gain access to ideas, network with others. We've seen some very interesting partnerships develop. I got a family here in the U.S. that's trading internships for their kids with an operation in Australia. So these kids are going to see operations around in those 2 points around the globe and expand their viewpoints. But we're very happy to be a part of this. We've been a big supporter for AFAN. We love being involved in their programs, listening to the last hour. I think there's some great opportunities out there for young producers. And we're happy to be here on the conference today.
Thanks, Bruce, and we certainly appreciate the support you and Chris, both of your companies provide us and continue to provide the work we do here in the state. Dave Van Pelt, Midwest Bank here in Lincoln. Let's hear from him.
Good morning, everyone. As Will said, I'm Dave Van Pelt. I work for Midwest Bank, which is a family-owned bank that has been in our state since the 30s. Currently, asset size, we have $871 million. Loan volume as part of that is $604 million. Commercial bank, I am located in Lincoln. We have a number of banks, primarily in the eastern half of the state, from Plainview to the north, Deschler to the south, and then Lincoln. Provide a complete line of deposit and loan services. I guess we really pride ourselves in putting our customers in the front, keeping an open mind to work with and tailor programs for each individual that we have the opportunity to work with. Myself, I've been in the ag finance business beginning in the early 80s, when it was extremely difficult time, to the point where we are today, and again find ourselves in an extremely difficult time. The textbooks continue to be rewritten. You try to grab a hold of some of that experience from the past and place it today, but we face a lot of unique challenges. There are some similarities, and so I guess we keep going forward, and I'm excited about the hog industry. As tough as it is, and the challenges in agriculture. My mantra is people continue to need to eat, and they need us, and all of you in the production side, and it's an honor and a pleasure to be part of this industry in whatever ways we can in the finance world, and look forward to the future and accepting and getting through some of these challenges. And thank you, Will and Steve and the staff at AFAN, who do a wonderful job, for the opportunity to be part of this panel and in this conference. It'll be an honor and an enjoyable experience to learn from each one of these talented individuals.
Thank you, Dave, and we certainly appreciate you being here with us, as well as the support that we receive from community banks throughout the state. Certainly very vital partners in financing projects throughout our rural communities. Brian Williams is here on the call this morning. He's an economist with Nebraska Public Power District. Good morning, Brian.
Good morning. As Will mentioned, I'm an economist here at, I'm in Columbus, Nebraska, at Nebraska Public Power District. I work within the Economic Development Department at Nebraska Public Power District. So what we do as a department is we work on recruiting new business, new industry to the state. We work on retaining existing businesses, doing what we can to help them to be successful. As a company, we serve electricity. Obviously, we serve the vast majority of the state, basically the entire state outside of the Lincoln and Omaha metros. So that's kind of who we are as a company. Really try to serve the state, try to help the state as a whole be successful. A little about me. As Will mentioned, I'm an economist here. I'm kind of the numbers guy, the behind the scenes numbers guy. Before I came here, I spent about 6 years in extension, working in kind of farm management, risk management, livestock, and row crop outlook type marketing and that sort of thing. So, and have a ag background as well. So, and also throughout there, we do partner with AFAN quite a bit. We go to trade shows with them, trying to promote Nebraska's animal ag industry and really just try to bring more industry into the state.
Thanks, Brian. And again, certainly enjoy our partnership and your perspective in terms of the economics and the numbers as we go out and try and recruit agricultural businesses here to the state of Nebraska. I'm going to go ahead and get into our questions here. I guess just a reminder, if anyone from the audience wants to ask a question of our panels here today, the Q&A box is going to be the best place to do that. We've got folks from our team that will monitor those and send them over to me as they come in. Brian, I'm just going to start off with you here this morning. Obviously, it's been a challenging year, not just in agriculture, but throughout the various economic sectors. COVID-19 has been a huge piece of that. What are you seeing right now in terms of Nebraska's? Let's talk about rural economy here in Nebraska, in our small communities, in our agricultural communities. What are you seeing today? What are the lasting impacts going to be, in your opinion?
Well, I think that's one of the good things about Nebraska as a whole. The impacts, I don't see them lasting beyond the next couple of years. If we look at nationally, U.S. GDP was down sharply for the second quarter of this year. It's forecast to grow a little bit in the third and fourth quarter, but we're looking at the U.S. GDP being down about 4.5% to 5% for the year for 2020. 2021 we're expecting to see some growth in GDP to kind of make up for some of that. As a state, Nebraska is doing better than most. One of the really only numbers that's available right now is unemployment. For the state going into COVID, prior to COVID, we were right around 3.1% unemployment as a state. Right now, the latest numbers we have are about 5.2% for Nebraska. So our unemployment is up, but it's still not too terribly bad. For comparison, the U.S. unemployment for June was 11.1%, and for May it was 13.3%. So we're sitting at less than half the unemployment rate that the rest of the economy is seeing. Why is Nebraska doing better as a whole? I think a lot of it comes down to what industries are strong here. So the industries that are being hurt the hardest by COVID are, your service industry and hospitality, those types of industries. Whereas in Nebraska, agriculture is huge, for example. And we have a lot more of the essential industries in Nebraska. So basically, we're feeding the country, we're moving the country, we are providing those supplies, those materials, that food to keep the country going. And so that helps us we may not have quite as high of a high, when the economy's booming, but that low is also a whole lot better than what the rest of the economy is here. And so we don't see that huge variation as much as the rest of the U.S. So that's kind of a good thing for us as a whole. In terms of questions that we really don't know about, number one is, when is there going to be a vaccination available? I think that's going to drive how the U.S. economy comes out of this and how quickly we come out of this, is whether there's a vaccination. Cases are spiking again right now in a lot of states. Nebraska's faring better than most at this point. What kind of impact is that going to have? Are we going to see more things shut down again? It looks like some states are imposing a few more restrictions. that could slow down growth for our economy as a whole. And then from a meat packing standpoint, if we see a second wave, how is that going to impact the workers? We've seen a lot of outbreaks at our meat packing plants in the state. Are those workers that had COVID going to be immune to it if there's another outbreak? So there's still a lot of questions floating around out there, but overall, as a state, we're faring a lot better than the rest of the U.S.
Let's kind of segue off of that and look at agriculture a bit more specifically, and we can bring in some of our bankers on this. You know, we've made it through renewals. We're at the midway point of the growing season for most of our row crop commodities. I mean, what are we seeing? What are you guys seeing in your portfolios? What are your concerns as we approach harvest and year end? Dave, do you want to lead us off with this?
Sure. I think a couple of things that at this point that we have some concerns about. The first one is evaporation of working capital and the equity within our lines, specifically the livestock lines. And I think, some of that can be attributed to, maybe a lot of it be attributed to the COVID-19 and some of the things that have happened in the packing industry. The prices, if we go out and would update the inventories that we thought were worth X in January, February, and March at the renewals, and if they still exist, which there is, what are they worth today, and the erosion of that, both in livestock and in the grains. So I think, that is a concern that we have going forward. On the grain side, we, in much of our state and in the areas that I've been in, it appears that we have an outstanding potential crop. Early contracts, some of those things certainly could help in some of those concerns that we have right now. I think another one is, and maybe at this point it is a perceived concern, but for our producers and the challenges they have to meet their existing term debt payments. And some of that will come about when you restructure debt. You, on the short-term side, loss of equity, you turn it into another term debt payment. And so we, have a concern in that and in how we will look when we get to the end of the year. We're a long ways from home at this point in July, but those, for us anyway, would be a couple of things that we have concerns about. Looking forward to getting out on site in the farms and visiting with producers and getting a little bit more information from them and their ideas as well. But those are a couple things that I see.
I'm going to bring everyone in on this. Bruce, if you want to share what you're seeing in your markets.
Yeah, we've we're in the fifth year of what we've generally described as stress in agriculture, kind of in general terms, diminished earnings and declining liquidity. And I think if you talk to any lender, you'll hear discussion about liquidity, because that's a real concern. I describe liquidity, it's like the oil in your crankcase. When you run out of liquidity, or that ability to pay your bills on time as they become due, everything just kind of seizes up, and it makes it very hard to operate. So we work hard to make sure that our customers are staying in looking forward at liquidity and finding ways to manage that in advance, so that we don't find ourselves in a very tight cash position. There's some advantages we've seen on these livestock operations where they have a contract that has a very stabilizing effect on cash flow, because you're paid for very specific actions in those contracts. And then a lot of times, as described in the last hour, the major market risks are managed elsewhere. And so that can be a real advantage for producers, particularly young producers. We've seen on the grain side, we've seen advantages for producers who, let me kind of state the situation. We've seen a lot of producers who produce a crop and then they go out to market that crop. And we've seen advantages for producers who drive to reverse that trend toward marketing the crop and then producing it. It tends to make a little bit better decisions around them, a little bit better decision makers around what to spend on a crop and what the real economic yield is in a grain operation. So, you know, on the livestock, now moving into 2020, good heavens, you know, we had to face things in the first half of this year that really none of us ever contemplated. You know, we couldn't move about as we normally would. We couldn't transact business as we normally could. So it was a challenge throughout the economy. We took a quarter of the value off of the beef, the market beef. We took half the value off of the pork live market value, and in some areas, you know, these animals couldn't be sold at any price because there wasn't any way to deliver. So it's, you know, it's been some really difficult challenges. I think in our portfolio, we've seen a lot of progress here in Nebraska. These plants are operating very near what they were operating at a year ago. And when you look at some of the heavier carcass weights going through the plants, they're within about 2% of their production a year ago. So, you know, a really strong recovery in terms of getting things running again. But in general, I guess to the, you know, with our audience in mind, the things that we're talking to our clients most about are liquidity, planning in advance, and maintaining a very close communication with us as the lenders. That's what helps everything move in good times and bad times. Great.
Now, Chris, I know your portfolio there at Farm Credit's predominantly in the swine sector. I mean, what are you seeing as it relates specifically kind of to the swine industry right now?
Yeah, so appreciate David and Bruce's comments around working capital. Obviously, is one of the key pieces that we're looking at as well. So I don't think it would be too much of a secret to say that we've seen pretty significant working capital dissolve over the last 6 months. And so I kind of take a step back and say, what did we see for year-end 2019, just from an overall profit standpoint across our customers, because it is strictly, when I talk about this, it is just mostly swine. There is maybe a little bit of grain production in there. And so we saw from a year-end across the producers that I said, the 19 of the 20, or across our entire swine portfolio, returns in the realm of right around break even, maybe a slightly less. And so I think anybody on this call who is in pork production today would say, I would go back to that today, just based on some of the returns that we're seeing. So, you know, what we're encouraging our guys, when we look at our portfolio and say, we break down that profit per animal and where were the opportunities? Well, risk management was one of the key opportunities for guys to actually make a little bit of money to try to preserve some of that working capital and some of those profits. And so we actually saw across that portfolio $2 to $5 per head profit just on the hedging or price protection side. And so what I'm telling guys today, and when we're talking specifically around pork production, is you got to understand your cost of production. What's it take you to produce a pig or buy a pig and take that all the way to market based on what your costs are, whether that your facility is rented, owned, your corn, whatever it may be. You have to understand that. Once you understand that, then you can actually start putting in some floors and some different hedging strategies. Because again, right now, as we look forward, there's not a lot of opportunities out there. But what there are opportunities to do is minimize some of those losses. And so if you understand what your cost of production is, you understand maybe what your working capital dissolve rate or burn rate is going to be over the next 6 to 12 months, you can kind of forecast to where you see this going. And so, you know, we talked specifically around pork production in the first half of 2020. It has been tough at best around the working capital, the equity that's been given up. But most importantly, I think, is just around getting those animals delivered to plants on time and staying current on your weights. because nobody wants to get into the situation of having to either take pigs out of the food chain or dispose of them otherwise. So we're just, again, encouraging our guys to understand your cost of production, understand what your forecasts are going to be, and really have good relationships with not only your lender, but also your packer and your feed brokers and whoever that may be. So that's what we're kind of encouraging our guys.
Real quick, I got a question here from the audience I want to go to while we've got you on, Chris. And we had someone ask, well, what is your long-term perspective or long-term outlook on contract production in terms of swine? Do you want to maybe share your thoughts on that, Chris?
I think contract production is obviously been a good piece of business, especially for diversifying portfolios or in getting young and beginning producers a start in agriculture. So I think the outlook on contract finishing production is going to become greater, because I think what we're going to start to see as we start to see this industry continue to see stress up in the next 6 to 12 months and maybe even longer, depending on what COVID or even a potential ASF if in the United States would do. We're going to see consolidation in this industry. And I think that's just kind of natural, what we see when we see these times. We saw it in '98, we saw it in 2008. We're seeing it again today, where producers are saying, I just don't have the economies of scale to stay with maybe the larger players or the more efficient players in this industry. And so what you'll find is we'll either mothball or take out of production a sow unit or convert that over to a finishing unit, and then take whatever own finishers that you have remaining and contract with an integrator that is looking for additional space. So I think that there's some optimism in regards to the pork industry, in regards to contract finishing, especially as we look at a place like Nebraska, which has a great stable food source. We have water here. It's just a matter of getting people to understand that this is a great diversification tool to tighter cash flows in the grain market and helping with that manure. And there's a lot of good things to come through with contract finishing.
Sure. Kind of to segue off of that, I know we've had a few folks on the call this morning that are either considering a new facility or perhaps expanding their current footprint. We've seen interest rates. I mean, the interest rates came down quite a bit. Brian, maybe I bring you in on this and get kind of your long-term, your 12-month, and then your long-term outlook kind of on the interest rate environment we're at right now, and from your perspective, what you're seeing.
Yeah, interest rates are low right now, and I really, in the long term, don't see them until we pull out of this and start seeing some positive growth for a quarter or two at least, and kind of pull out of this recession. I don't see in the next year or so interest rates going a whole lot higher than where they are right now.
Anyone else have anything they want to add on that?
I'll just speak to that, just very similar to what Brian says. I had a conversation with the CFO here at Farm Credit, because I knew that the interest rate question was going to come up. It always does. Everybody's interested in what rates are going to do. And so basically, kind of in a gist of what he was saying was, when we look at the futures market on rates, there's really no indicator right now that the Fed's going to move rates any time before March. And actually, all indications say that they're probably going to hold steady for the next 2 years at best. So when we're looking at long-term rates, we're looking at some of those rates today. Right now is a good opportunity to to be borrowing if you have to or if you need to. Long-term rates are as low as I've seen them at my time at Farm Credit Services America. So and again, like Brian said, until we start to see significant recovery in this country, they're going to remain low. And again, we're obviously in an election year, and I think that probably comes into play as well.
Kind of want to segue back a bit. We visited with you guys about some of the things you're seeing in your portfolios, some of the distresses that you're seeing in some of your credits. Obviously, there's producers out there, and likely producers that are listening to this program today that are feeling the pinch, feeling those the distress of perhaps multiple years of loss. I mean, what are you guys telling your producers? What advice do you have for some of those guys that are dealing with those challenges? Do you want to lead us off, Bruce?
Sure, thank you. If you look around, the best managers in the industry have been in a difficult spot and managed through it. I mean, they've figured out how to solve a difficult financial problem or production problem in their business. And so my advice, if you're feeling stress, I would lean into that and really critically evaluate what's driving the stress. I mean, it's easy sometimes to look at markets and say, yeah, it's really lean, and that is very true right now. But there's also efficiencies that we can gain in our own operation. There's actions we can take as owners and operators to to be more durable against these kinds of stresses, because we live in a cyclical industry, and so there's always going to be ups and downs, and we really need to be building our businesses for the lean times. When times are good, make sure that we're building efficiency into our business, because it's easy when times are good to be a little bit loose jointed in our spending habits. So I guess our advice, when times are lean, be willing to talk to the professionals that are in your business. They might be on the production side, they might be in your finance, they might be in things around taxes or estate planning, but lean into those discussions and gather as much information as you can. Be very open and candid with people when you're in those discussions. Communication is a key skill in terms of managing through good times and bad times. And so I would say be very action oriented, be very willing to communicate, be willing to listen, hear what the people who are in your business with you are telling you, and respond in ways that make financial sense and make production sense, to improve your position.
Dave, anything you want to add on that?
I would echo what Bruce said. When I looked at that question, probably the one thing that I think that we need to really be good at is communication, and Bruce talked about that as well. I think the customers to the banks to the customers, be effective in those communications, be open and honest with what you see, do it on a frequent basis, so that everybody is understanding. Sometimes there's a misunderstanding, and then decisions are made on bad information, and they look pretty poor when you have hindsight and you come back on it. So I think communication will be a key. And then Bruce also talked about, making decisions. So get as much information from the folks that you have, know your business, and look where you currently are. And then even the difficult ones, be willing to execute the plans that you've developed through your communications and your study. Some of those maybe don't look so great in the near term, but you're really looking, at what's best for you and your operation, your family in the future. So those would be the things that, that I would to counsel potential borrowers to work with.
Chris, anything from your end?
I think the only thing that I would just reiterate there is when we talk about cost of production and understanding what that is, and I think that's first and foremost having that communication with your lender. But I think one thing that we have found at Farm Credit Services America that sometimes slips through the crack is just understanding how much are you truly spending on your living expenses. And when you have a family farm that's reliant upon production agriculture, you focus on the cost of production, you focus on producing as much as you can of whatever it is that you're producing. But sometimes you forget about how much it's actually costing, or what you're living towards. And so that obviously comes to impact to the overall cash flow of the farming operation, and that just be another area that really needs to be focused very hard on, because that's, again, an area that sometimes gets overlooked.
Absolutely. Chris, I've got a question here from the audience that I think I'll send your way. We've got someone asking in terms of hog barns, are you seeing more loan requests for remodels and renovations versus new construction right now, given the current environment? And kind of what's your outlook on that?
Yeah, I think a lot of that is going to depend on what those remodel type requests are going to be. If that's a remodel request to fit within that to obtain a new integrator contract, we're seeing some of that, and we're seeing some new construction. But honestly, I think both of those areas are probably down, at least now until we figure out exactly where is this thing going to shake out at. And so whereas I think it's important to make sure that we're keeping up our facilities and keeping the remodels there to maintain that contract with an asset that has some value. We're not seeing a lot of capital spending right now. Guys are sitting back right now and just being cautious. And again, we talked about working capital and preservation of that cash flow. They're sitting back and just kind of waiting to see what happens with I guess continued stress in the hog marketing, but also on the packer side, to make sure that we're keeping a close eye on some of those things and really trying to get by with duct tape and baling wire if they can, at least until we get into the 2021, where there's maybe some opportunities to make some profits again.
Absolutely. Kind of want to segue off of that. Quite a few of our questions this morning have been related to contract production and in construction of facilities, and fittingly so after the conversation we had the previous hour. I guess I'll go to Bruce now. At Rabo, do you offer any special financing programs for these kind of facilities, or are you kind of structured where you can put these deals together as it best fits, or how do you approach these contract production credits?
Yeah, we do build our financing products to match each client, but we do have a program called Rising Stars. It provides young producers with some advantages in both terms and pricing on the loans themselves. But I think equally, or possibly more importantly, it helps them to network and collaborate with other producers and experts in their field to develop their knowledge of the segment that they're working in, and also provides access to training to help them develop their skills that are important for their operation. So it's kind of a holistic approach to developing great young production talent in the industry. But again, I mean, each of the financial products that we build are designed to fit that request. So the Rising Stars is really designed to just give them some enhancements to what we would normally do in a request process.
Chris, how about you guys?
Yeah, we have a couple different programs that we like. I think Carl mentioned one that we have partnered with the mash shops to work with a contract finishing program with them, which is a low down payment program to kind of give young and beginning producers, or really any producers, but producers an opportunity to diversify their portfolios. If they have grain production, or if they do cattle production or something else, that they can kind of diversify that cash flow stream. We also, not to just be financing just mash off barns, we also have a young and beginning program that we've had for a number of years, ever since I can remember. But Ag Start program, or young and beginning, and part of that, a part of that is a development fund, which essentially gives young and beginning producers that are under the age of 35, less than 10 years of ag production, or $250,000 or less projected annual gross income. It gives them a loan to use towards whatever production agriculture, whether that's to buy a piece of ground, it's to put up a hog facility, a chicken facility, or whatever it is, buy cattle, whatever that may be, to get them started. Because again, as we know, where land prices have been over the last 8 to 10 years, it's been very difficult for these producers to get a niche into production agriculture through just straight grain farming. Because again, grandpa and dad, or grandparents and parents, are typically sticking around the farm a little bit longer because it's been tight to work longer. And so those opportunities don't come around much. So there's the two different options that we have, or a couple different options that we have for young and beginning producers.
Great. And just want to remind folks, if you have questions, you can submit them through the Q&A. We've got about 15 minutes left here with these guys. Both Bruce and Chris, you kind of hit on that young producer, that beginning producer, some options that are available to them. Dave, I want to throw it to you from your perspective. Do you guys work with FSA or anyone like that? So if you've got a young producer that maybe has a good business plan, maybe has a little bit of equity to put in a deal, but there just might be some deficiencies there. Do you have some programs that you can work through to help finance those deals, or what advice would you have?
Midwest doesn't specifically have a model, but rather would look at each individual request and then, like Bruce was saying, build that request around that particular situation, and certainly FSA becomes a part, many times a large part of how we would put together a deal that potentially was a little light on the cash or the equity side, but had a good plan that were ambitious, hardworking individuals that we felt with a little bit of assistance could make that go. So looking at each one, certainly utilizing the FSA, SBA potentially on some land deals could be a part of that, but trying to find whatever resources that were available and then putting that package together so it would be the best fit for that request.
Absolutely. And I guess just, maybe want to look at this a bit more broad. I think that, from my historical perspective and the audience, a lot of times we get on these programs, we do have a lot of young producers. So if there are young producers out there that are listening or beginning, producers maybe in their first 5 or 7 years of production, I mean, what advice do you guys have for them right now if they're looking to expand, if they're looking to grow that operation? What advice would you give somebody in their 20s or 30s right now? Bruce, you want to lead us off?
Well, I think if you're in your 20s and 30s and you're working in agriculture, you're in a very, very good position. One of the interesting observations I've made in my career, I've been in ag finance for 25 years, is when we're at the low, everybody's drawing a straight line down, and when we're in the high, everybody's drawing a straight line up. But when you look in the history, it kind of goes up and down all the time. So, just be aware that there are better times ahead, but there'll also be more adversity ahead. So build your business to be durable, to be able to withstand those changes in the industry. I think early on, one of the most important things that you can do for yourself is to build that base of capital. And that capital needs to be distributed across your balance sheet in both term and current of assets. And in our experience with existing clients, with our observations of some of the new developments in the industry, especially in Nebraska, on this contract production, these can have a very stabilizing effect. It can be a little bit like an annuity. I mean, you're doing certain tasks, you're performing those duties, and you can earn bonuses and enhancements to that. But at the end of the day, you're not really taking the entire risk on that project. So it's a nice way to partner up, a nice way to share the opportunity with somebody who's experts in that particular field. So we're always supportive of the contract production concept. We just try to find ways to make it work in each individual deal. I think long term, if you're young and you're in agriculture, you're in the best place. It's a great career. It's a great life. I've stayed involved with my family farm through all of my life, and that's where I go to have fun. So it's a great lifestyle. Don't be discouraged by the hardships that are right at our feet today, but look beyond that. Be creative. There are opportunities developing in the industry around some differentiated products. some specialized type products that can carry some pretty significant premiums, but they also require specific management and abilities. So, there's a lot of opportunity. Just have your eyes open. I've told a lot of people that there's a lot of opportunities in agriculture right now, but they look a little different than what we've been doing for the last 3 generations. So just be open to changes and looking around at what you might be able to do with your operation and your resources.
Brian, you bring a bit of a different perspective to the table here. You have any thoughts you want to share on that?
Yeah, some of it I would kind of echo what Bruce was saying. In many ways, while markets really aren't the greatest right now, it's probably a good time to, from a long-term perspective, to cut your teeth, so to say, because when things are tight, you learn to manage things a lot more carefully, and it sets you up for more success than if you were to be jumping in when things are great and the prices are high, and maybe, I think Chris mentioned earlier the family expenses, cost of living, those sorts of things, and maybe let things get a little bit out of hand when things are great. But if you're cutting your teeth when things are tight, you just learn those management skills, and you hone those management skills so much more.
Dave or Chris, anything you guys want to add?
I think it's, in the changing environment, I think it's really important that you look at the whole landscape and keep an open mind to different things. Diversification, I think, if it's possible, is really important. We spoke about communication, or I spoke about communication previously, but I think for a young producer, I think, again, that with potentially family, if he's involved with family, landlords, if they're involved, again, back to the finance side of it, input, what have you, be a good communicator, keep your mind open to, potentially other things that maybe long-term you haven't seen before, but might be something that's going to take off, and that would really help you. And then spend time in the office. I think many times, in agriculture, we love to be outside and we love to grow and produce. But I think, with the volatility that we face in our industry right now, I think we need to spend time in that office, however painful it might be, depending on the individual. But know your costs, which were mentioned before, the risk associated with that, and manage that as best you can as you go forward.
Yeah, excuse me. I think the only thing I would add, I'd go back to the contract finishing as an opportunity for the younger beginning producers. And again, where interest rates are at today, caused by some of the economic challenges that we've dealt with as an industry and as a country, I think provide opportunities. And so even if we're going through these tough times, out of this is going to be a lot of opportunity for those that are willing to do the work, and those that have the capital that are willing to put towards continuing to grow or become better in this industry and in agriculture. So I guess if you're willing to do the work, and I'm talking specifically to contract finishing of a hog barn, I think it's a great way to get into agriculture and get into animal production with limited risk, and the opportunities with any lenders that you have out there, or any of the integrators, is providing a low capital type structure that cash flows itself as long as you're willing to do the labor, and you can benefit with things like manure back on land that either you own or that you're farming, and you're going to capture some more margin that way too. So diversification, I think, is important, but also finding a way to utilize every piece of something like a hog barn, where you're using the manure, you have a labor source, you have cash flow. Again, there's other benefits that come with that, with depreciation and some other things that come through that will help your farming operation as a whole.
Thank you, Chris. We've got about 5 or 7 minutes left here. If anyone wants to get in a quick question, be happy to take that. I guess I would just kind of, go to this. We talk a lot about working capital and liquidity. Cash is king. I think it's hard to argue that. But if there's producers, listening to this program that are taking a look at their cash flows, taking a look at their balance sheets, their financials, I mean, what performance indicators should they be looking at? What's a key takeaway you want them to keep in mind as they work through that and take a look at that this year? Bruce?
Yeah, I would kind of in a word, I would say focus on efficiency. We've talked, I think Dave spoke to family living expenses. Chris spoke to, running the business well. I think that, and Brian has testified that, we're probably not going to see big increases in the cost of purchased capital or debt. So, really what you manage well, what you can manage in your business is the efficiencies in that business. Are you capturing some of the new practices and technologies that can reduce your cost of production? Think openly about what you're doing every day, and does it need to be done? Must we spend this to get the results that we need in our business? And be willing to be critical about your own operation. And then the other piece I think that we spend a lot of time thinking about and talking about is just risk management. What are the real risks in your business, and are you managing those risks? It's hard to grow a crop or an animal, without dealing with some type of adversity. And when you've done it for a number of years, you can start to see that, there's weather risk, there's price risk, there's health risks to your livestock and crops, and just be really active in identifying and actively managing those risks.
Dave?
I agree with that. I think, efficiency is going to continue to get more and more important, margins narrowing up. One of the things we look at is your coverage, your term debt coverage ratios in these difficult times. And when you're going through and taking a look at, potentially growth, new projects, survival possibly is a word that comes in. Look long and hard at that. The coverage that you have, hopefully there's some margins in there at least part of the time. I think for us, managing term debt, managing your balance sheet at this point, being open-minded to changes, I think would be really important.
Chris?
Yeah, I think just to hit on some that I think are important when we're looking at and analyzing financial statements. Obviously, current ratio, which is a measurement of the working capital. When we look at an owned production operation, we like that to be somewhere around 1.5 to 1. So that's 1.5 current assets to 1 liability on the balance sheet. We look at comparing our producers across everybody in regards to like a benchmark to kind of give some perspective around like a working capital per sow or a working capital per pig. And so from working capital per sow perspective, we like that $500 to $600 per sow. And then when we're talking about working capital per pig, $40 per pig is typically what we want to see on the lower side. And again, as we work through some of the challenges of working capital dissolving over the last 6 months, or even over the last 12 months, you could say, we're helping to navigate through that and help customers continually become better. Dave had mentioned, coverage, 1.35 to 1 is kind of where we want to see from a debt coverage to make sure that we're able to cover those payments. And when we look back on a contract finishing, it's a slightly different income stream. We lower those standards a little bit down to a 1.2, because again, it's more of a steady stream of income and not nearly as risk or as risky when you look at that. Obviously, the earning measurements that we're looking at, ROA, ROE, ROI, we're going to look at those things. And so making sure that you're staying up with pace. And then when we look at it from an equity standpoint, owner's equity, 45 to 55% is kind of where we want to be as a minimum. Again, obviously more than that would be better. And then when we talk about a true contract finishing or a young and beginning producer, 35% is usually our target around some of those equity measures, knowing that those producers have less assets bruce or less capital in their operation, but we kind of take those considerations when we look at the underwriting standpoint. Bruce had mentioned some of the efficiencies. We talk about production. PSY, 26 pigs per sow per year is typically kind of an average when we look at this, but we have a lot of producers that are producing over 30 PSY today. So obviously the more pigs that you can produce out of the same type of fixed cost, that's going to help you in the long run on a cash flow and a working capital management. You need to continue to watch your cost production. Our typical cost production that we're seeing for most of our producers are in that $50 to $52 per hundredweight. We're seeing some producers that are less than that. We're seeing some that are more, and the ones that are more than that are probably the ones that are starting to see a little bit more stress sooner than some of the others. So again, those are some of the areas that we focus in on, that working capital, that cost of production, make sure that we have that coverage ratio so that we're prepared for times like what we're experiencing today.
Chris, appreciate that. I think some great insight and some great metrics we can take a look at as we progress through the year. We're about at the top of the hour, I guess. Brian, you have any parting thoughts you wanna share with everyone?
Well, I guess Chris keeps hitting the nail on the head when it comes to the cost of production, and really, knowing that can go a long ways. Whether it's your marketing efforts or anything, especially in times like this when margins are tight. Knowing that cost of production, knowing where you can maybe cut things a little bit, where you can tighten that belt a little bit. And from a marketing and risk management standpoint, knowing what that target is, what that target price, that break-even price is, just knowing all that information and putting that pencil to the paper makes a huge difference.
Well, thank you guys. Appreciate all of you being on here today. Again, for anyone watching at home, all of this will be archived and available on our website. Again, we have Bruce Eberly, Rabobank, Dave Van Pelt, Midwest Bank, Chris Ford with Farm Credit Services, and Brian Williams with Nebraska Public Power District. So again, thank you all for being with us today. Really appreciate the discussion. I want to